Hello and welcome to the Sim Rumi Show. Now, today I would like to discuss the recent events surrounding the coronavirus and do some economic analysis to see essentially where the world is heading. Now, you have probably seen the S&P 500. It has lost, well, quite a significant amount of gains over the past few weeks, and a lot of people have been saying that we should buy the dip. That is, buy when stocks are cheap. Now the question becomes, is there room for more failure? Are you catching the falling knife, so to speak? Or is this exhaustive and markets won't fall anymore? Now, the first thing to do is to look back on the S&P 500 and you already see that there was a dip almost equivalent in size just back in 2018. So if you have bought there, you would have broken even. If we go just a bit back, you can see that back in 2017, the stock market was essentially on the same level and you would have actually just broken even as well. So essentially what we have is the destruction of 2 years worth of stock market gains. That essentially includes all of Trump's rally, all the gains since Trump came to power. And the stock market has been one of the main gauges used to evaluate his performance. And that's something he emphasized all the time since the beginning of his term. And now that he's falling, his chances of getting re-elected have actually shrank dramatically. If you look at the betting markets, Trump is losing to Joe Biden. Now, if we look further down the line at 2008 and even at the dot-com bubble, we'll see something interesting. That the peak in 2000 almost coincides with the peak in 2007. And the low point of 2003 post dot-com bubble and post 9/11 coincides with the low in 2009. Why is this interesting? Well, because we see the market reaching new highs, never seen before highs, and then falling, and then regaining those and falling again over the course of essentially 2 economic cycles. But currently, the stock market is in a place, again, where it never has been before. But as we have seen, it can fall to a level where it can reach the low of the previous cycle. So it is quite possible that the stock market might fall furthermore. Now, most people doubt it can fall to 700. If we look now at the real economy, we will judge whether that's possible and what can drive it further down. I guess what I'm trying to say, to summarize, is that there is room to fail. The stock market can go to the previous high of 2007. So before buying the dip, you should be aware that you could be catching a falling knife. Now, if we just look at some of the real economic events that are going on and that are largely driving investor panic, things like this. California governor issues statewide order to stay at home as coronavirus cases soar. Now, California is essentially on its own the 5th economy in the world and the biggest economy in the United States. 40 million people live in California. Apple is based in California. The Silicon Valley is based in California. What this shows is a precedent. New York can close down. Other big cities in the US and across the world, such as London for instance, a big one in Europe, are on the verge of quarantine and lockdown. This is extremely dangerous. And this damages the real economy, the main street. This goes beyond stock market panic. We have businesses such as airlines, businesses such as restaurants, small and medium-sized businesses all being hit because people can't go out of the house. If people can't go out of the house, the only thing they can do is do some internet browsing, renew their Netflix subscription, and this actually has been happening quite a lot to the point where in Europe, Netflix and YouTube had to reduce the download quality because the internet infrastructure cannot handle the increased demand of people going into quarantine and watching videos in their free time. The demand is just too big for them to handle. And this brings out quite a significant point. Now, what real effects will this have? Well, it will likely cause a recession. And if we look at some of the speculation going around, well, US economist at Oxford Economics says there's a 0.4% in the first quarter decline in the first quarter and 12% in the second. And Goldman Sachs says 24% drop. Now that has never been seen. For reference, in 2008, the decline was 2.5%. Only 2.5%. And here, Goldman Sachs is saying 24% is possible. Now, bear in mind, even if it's 5%, that's insane. But why are they saying that's possible? Well, that's because of the abruptness of the descent. Near lockdown of major cities. London accounts for a humongous percent of all financial trading. If we look at Italy, again, small and medium-sized businesses are affected the most. And why is that important? Well, in the UK, 60% of people are employed by small and medium-sized businesses. These businesses comprise 99.9% of all businesses in the UK. And the same is true for Germany, Italy, and all the European states are mainly made up of small and medium-sized businesses. The same is true for the US. And these businesses do not have big credit lines. They cannot survive for long times without revenue. They still have their fixed costs to pay, even though no one is coming to the store. The variable costs don't matter that much. They can dismiss their employees, which is of course another bad effect. And they have to pay these fixed costs. They have to pay rent. They have to pay interest on machinery. So quite a lot of this comes down to the fact that they just cannot survive for many months. But that's what it seems like is happening. Even in China, the outbreak lasted for at least 2-3 months, and they imposed severe quarantine measures, which damaged the economy but managed to prevent the coronavirus spread. Now, even if we were, and by we I meant the US, Europe, UK, would impose such measures, businesses would still have to somehow survive for 2 months. And that's presuming we could safely remove the quarantine measures at that point, which is probably not the case. So now we can look at GDP breakdown by value added by industries and see what exactly is happening to the economy. Now we can look at some of the hardest hit sectors. Now airlines, air transportation accounts for 150 billion of the GDP. This has been virtually destroyed by quarantine measures, and now Trump's ban on flights from Europe as well is quite damaging. So 150 billion in the first quarter of 2020 could become just 20 or 30, just essential travel. That would wipe up 100 billion, almost 1% of the US economy, just the airline industry on its own. And now I think it's a good time to bring up the second point, aggregate demand in terms of incomes. Even if people were able to buy things physically, would they do so? Probably not. Even if the sectors that were hit were only these sectors, air transportation, and now we will discuss some of the entertainment like spectator sports, performing arts, restaurants, even if just these sectors were damaged, this is potentially hundreds and thousands of people unemployed, which means the total demand in the economy would fall. And that means that businesses would experience cash shortages. That's assuming that we're not even on full quarantine. So the total fall in incomes across these sectors would result in falling incomes across other sectors like manufacturing, retail. And then that consequently would lead to unemployment in these sectors and more shortages in incomes across the population. Additionally, that would create more uncertainty where people don't know whether they will have their jobs, and they will be limiting their spending because no one wants to throw on money. Now, most Americans don't even have savings, less than $400 on average. That's not enough to even last a few weeks. So most people in these conditions, at least hopefully, will try to save some money so that they have some cash reserves to fall back upon. Now, the consequence of that is a decline in aggregate demand and almost a self-fulfilling prophecy where people are trying to save in order to survive, but as a result, there's less money going around in the economy and they will likely lose their job. Now let's look at the sectors in detail. Well, there's the performing arts sector, another 1%. Now that has been virtually wiped out at the moment, so that's a 1% loss. Amusement, gambling, Las Vegas has shut down their casinos. That's 95 billion, less than 0%, but still quite a big amount. Food services and drinking places. Well, of course, that won't be completely wiped out. We still know that deliveries are going on. But bars, pubs in the UK have just been closed down. And that's 2% of the US economy. Now, imagine if that shrinks by half. That's 1%, 1%, 1%, and airlines another 0.5%. That's 2.5% just from the hardest hit industries. Now, again, as I've mentioned before, in 2008, 2.5% is exactly how much we lost. What does that say? Well, that basically says that the situation is quite bad. Now, if we look on other impacted industries, such as real estate, namely, which compromises 13% of the economy, we will discover that actually the number will probably be much larger. Now, people in uncertain income situations won't go out and start buying housing, struggling to pay rent as it is with falling incomes. No one's going to buy a house. Plus, buying a house requires actually for you to physically go out of your house, which is not something that's even allowed anymore in places like California. So the housing industry will suffer quite a lot. Renting, no one's going to go to another state and rent a house, most likely in these conditions. Everyone's going to stay at home. Again, renting and leasing services, 1%. The entire real estate sector is probably going to experience quite significant contractions. I have seen a couple of REITs before, sort of derivatives based on real estate markets, and they have experienced more than 65% contraction as far as I'm aware. That's a significant part of these 13%. Now, if we go looking further, we can look at manufacturing primarily, which compromises another 11% of the US economy. And again, durable goods, which businesses buy as investment essentially, is something that will certainly contract. Businesses are not going to buy or invest in machinery when they can barely pay off their current machinery. That just doesn't make sense. And again, that's a 6% of the entire US economy. That's potentially another few percentage points off. And if we look at other manufacturing goods, same thing. Machinery, primary metals, which are needed to construct machinery, computer and electronic products. Who will buy a fancy computer when they can't pay their rent? And we can go on, but the total industries I have identified compromise around 40-45% of the entire US economy. Now, of course, that's not going to be all wiped off, but let's say a conservative estimate would be 10% on average. Some industries will, of course, be completely wiped out, like air travel, potentially. Other industries will probably survive to some extent, but if we take an average of 10% across these industries, we will lose around 900 billion, which is quite significant. That's actually more than 4% of the economy. Now, whether the stock market will fall as a result of this will primarily depend on what the investors expect. What kind of downfall do they expect? Do they already expect a 20% fall like the Goldman Sachs? Or do they expect just a tiny drop? Now, the stock market has collapsed quite significantly in response to what they perceive to be decreased future earnings. But do they expect these earnings to decrease by a bit or by a lot? Unfortunately, we don't really know. What we know is that it has started falling almost immediately after we found out about the coronavirus, and with little information. And this information is just coming out. There has just been a report that China is potentially contracting 7% in the first quarter, which again is another interesting statistic to go by. 7% in the US would be quite devastational, at least that in my opinion. So now let's look at what the government can do. let's look at what the government can do. First two things they can do is either use fiscal or monetary policy. At least in 2008, both were used. However, monetary policy has largely been ineffective after 2008 because most interest rates have been at 0%, which has created what's known in economics as a liquidity trap. So what's a liquidity trap? Let me explain this to you through a quite simple economic model. Now, on the x-axis, we have money supply. And on the y-axis, we have the interest rate. Now, the MD curve is the money demand curve. It reflects the points and combinations of assets versus money that you would like to hold at each interest rate. So if the interest rate is 10%, you would want to hold little liquidity and more assets because the interest you can earn on this is quite high. So of course, as the interest rate goes down, you would like to hold less and less assets, or there's less and less preference for assets, and you would prefer to hold liquidity. Now, this is not true for the money supply curve over here, MC1, which is supplied by the central bank and holds no relationship with the interest rate. They just essentially arbitrarily set a number. Now, what does monetary policy do? Well, monetary policy effectively shifts this money supply curve to the left or right. If you're pursuing expansion in your monetary policy, that shift goes to the right. So the money supply is expanded for every single interest rate. And that's exactly what the banks did in 2008 to drive down the interest rate and are now trying to do in response to the corona. More on this further down the line. So what's the liquidity trap? The liquidity trap arises when money supply is expanded and expanded until the interest rate is essentially zero. The nominal interest rate is essentially zero, and where people have no preference for holding money or liquidity. Because think about it this way, if you have 0% on your assets, you won't really want to hold assets because they can also fall in price. Why would you take that risk if you can just keep it in cash and earn 0% anyway? So the zero lower bound happens. Essentially, the monetary policy has this zero lower bound liquidity trap beyond which it's completely ineffective. And that's exactly actually what's been going on. Because interest rates have been zero, we will now see how this affects the banks in the current situation. So if we look at the Federal Reserve website over here, we will see a significant drop on the 3rd of March, a 50 basis points decrease, and then on the 16th of March, 100 basis points decrease to 0%. So essentially, interest rates were at this level, 1.75 to 150, and were now reduced to 0% over just 2 weeks. Now, the last time this drop, if we just scroll further back, was in 2008, a 100-point decrease. That was actually even less than now. Last time before that, I believe, was on 9/11. So this has not probably sent a good signal to the market when they see the Federal Reserve doing such a rapid change. But why was it done? It was done to raise confidence to the market, send the message that the central bank is prepared to do anything. But again, has been ineffective. Now, the other reason, of course, is to actually provide consumers with relief. They will have to pay less in interest rates. And the same for businesses. They will have to pay less in interest. Mortgage payments will go down, which is really helpful to the real economy actually. But ultimately, a 1% drop is not very sufficient on any sort of level. And I think the markets have felt that it is very, very little. And if we go around to the ECB website, the European Central Bank, we'll see that they actually have some form of negative interest rate and zero interest rate. So they actually have no margin. Again, that's reflected in their policy. I will show you a small video now of the chair of the governing council of the ECB discussing their policy approach.
Governments and all other policy institutions are called upon to take timely and targeted actions to address the public health challenge of containing the spread of the coronavirus and mitigate the economic impact. In particular, an ambitious and coordinated fiscal policy response is required to support businesses and workers at risk. The Governing Council strongly supports the commitment of euro area governments and the European institutions to joint and coordinated policy action in response to the repercussions of the spread of the coronavirus.
What I would like you to recognize is how often she uses the word fiscal stimulus. Timely, continuous, coordinated fiscal stimulus. Now, she seems to be very much emphasizing fiscal stimulus over monetary policy. But this is essentially because the ECB is in a liquidity trap right now. It can't do much. So they have implemented this asset buyback program, a flexible asset buyback program, where they essentially said, we will buy 750 billion worth of debt that the private sector won't buy. That can be Greece corporate bonds, Italian corporate bonds, but also Italian government bonds, Greek government bonds. So both private and private bonds or debt. Now, this is potentially a good way to save businesses by just pumping in money into the economy. This is essentially a form of quantitative easing, quite an advanced form of monetary policy, and is used as in situations where standard monetary policy, displaying around with the interest rate, doesn't work. And if we go to the Bank of England website, again, we see a 50 basis points decrease of the bank rate to 0.25%. Again, liquidity trap. And again, if you look further into this, you will see some form of continuation of asset buyback program, some advanced form of QE going on. And again, they have mentioned small and medium-sized businesses. Their goal is very much to try and save these businesses. So in light of all this, we now have to look at fiscal policy. The point of fiscal policy is to stimulate aggregate demand, use this multiplier to try and increase the amount of income in the economy and drive people to buy from businesses, and then businesses can reinvest that money and so on and so forth. So $1 invested into the economy can turn out to be more than $2 in terms of the liquidity in the economy. And actually, there has been quite a significant emphasis on fiscal policy and some humongous packages being proposed. Trump seeks stimulus package potentially worth more than $1 trillion, including direct payments to Americans. I believe that's $1,000 per adult and $500 per child. And look over here, Treasury Secretary Mnuchin says unemployment could reach 20%. I think that he meant the worst case scenario over here. But still, that's a lot of money. And here we see 200 billion to 300 billion in small business assistance, and then directly to airlines. Again, they're trying to save the core of the economy, businesses which have very little credit. When monetary policy is failing, they're trying to directly insert cash into the economy. And the interesting part around this is that this is essentially the Republicans working together with the Democrats, just like they did back in 2008. Now, if we look back into the UK has also implemented something similar. They have implemented £350 billion loans and grants to small businesses. And then Italy as well has implemented a program where they're prepared to give 25 billion. The Italian government is prepared to give 25 billion worth of euros to businesses. Now, how does this compare to 2008? Well, the size of the cash bailouts is for now still probably on the lower side, maybe not for the US, but for the UK, for instance. In the UK, in 2008, 950 billion or around so were given to failing banks. And right now, the cash bailout is 350 billion. But the interesting part around that is that in 2008, and some people might not know that, most of the bailouts were paid back within the next few years. The US government, and so did the UK, actually took a stake in most of the companies they bought. So essentially they nationalized them. And eventually that stake brought a profit, or some of the money that they loaned was actually paid back with interest. So The taxpayer benefited in multiple ways. We preserved these businesses from failing, thus preventing a complete collapse of the financial system and the economy. And then the taxpayer also earned interest on the money given. We got the money back with interest. Now the problem is banks are normally quite profitable and they can earn enough money to pay back any loans, provided we're not in a recession. Now over here, small businesses and medium-sized businesses and even taxpayers normally live paycheck to paycheck and won't be able to afford to pay back these loans. So whereas before we actually gave loans, here it's a full-on bailout that won't be paid back. Now, I'm not trying to scare anyone. That's not necessarily bad. Given that we are projected to potentially lose 20% employment, that might just save it. That just might make it bearable. The markets don't seem to have reacted to this. At least the sell-off has sort of subsided, at least has sort of stopped for a couple of days. The stock market has been on this 2,300 level for quite a while now. But interestingly, the amount of government debt has been rising for quite a while. And now some people, mainly from the Republican side, have always been apprehensive about increasing that, although now they're very much in favor of any measure to save the economy. And I think electoral pressures are helping them make this decision. They don't want Trump to lose, so they are very much prepared to spend cash hand over fist. And there have been quite a few discussions in the world of economics whether debt is sustainable. And I think it comes down to a very simple equation. If the GDP grows faster than what you're paying on your interest rate, then you are fine. Essentially, and a lot of people are scared of saying that, you can borrow indefinitely. Advanced countries can borrow indefinitely, as much money as they want, as long as in the long term, their GDP grows by more than their debt. Italy, which debt compromises 135% of GDP, is in a precarious position. No one probably wants to loan money to Italy since it's in such a position. And because of its high debt levels that kind of do stand out on an international level, they might have to pay a higher interest rate eventually to creditors, and that limits Italy's borrowing capacity. Of course, other European countries, such as the UK, are very solid creditors. They unlikely will budge under this. The end point is that these countries, and I mean the US, and the UK, and Germany, can sustain their debt. So they can actually pump a lot of money into the economy, a lot of fiscal stimulus, coordinated fiscal stimulus, without repercussions, potentially saving the real economy, SMEs, from this coronavirus outbreak. Now, how will that affect the stock market? Well, again, it all depends on what will happen with the real economy and what investors expected. I personally think there's definitely room to fail. But a coordinated fiscal response, the one we're seeing now, unprecedented really, can really help stop the bleeding like it did in 2008. So this is the end of it. I hope you enjoyed the episode. If you did, please like and subscribe. I'll be soon coming up with much more videos